Good morning. Wednesday, April 8th, episode 3 of Three Clowns. I'm Alex. Tom is here. Tech, growth, AI, anything that runs on a chip. And Ray, macro, rates, the Fed, the economy underneath the numbers. Glad you're with us.
Morning. I've had coffee, so expectations are already too high.
Tom, man, if the market volatility today is even half of what your caffeine levels are currently doing to your heart rate, we are all in trouble. Morning, guys. Good to be back at the table.
If my heart gives out mid-episode, just mark it down as a liquidity event. Very on brand for this show. Also, Ray, you laughing like that this early is aggressive. Some of us are still buffering.
Well, I'm just saying, if the neighbors didn't call the cops during your bagpipe practice this morning, they definitely aren't going to mind a little mid-podcast enthusiasm. We're lucky to be here, Tom.
All right, let's get into it. Overnight, Iran ceasefire, 2 weeks, Hormuz is reopening. Oil is down 11% pre-market. Everything is ripping. Futures up 2 to 3.5% across the board, small caps leading. The manageable inconvenience drawer from last episode? Contents are on the floor. FOMC minutes hit at 2 today, which is either confirmation or the fade. And Tom, your Tesla call from episode 1 is still alive. It's at 363 pre-market.
Yeah, turns out geopolitics is just a cell in the model now. You had Hormuz equals closed, breaking everything. Now it flips to 2-week ceasefire, and suddenly the same spreadsheet says, actually, growth is fine, carry on. Nvidia up 3.5 pre says the market's choosing productivity over input costs again. Basically, yes, energy might spike, but AI will outrun it, which is a very calm thing to believe about two variables we don't control. Apple being red in a plus 3% Nasdaq tape is the tell, though. That's not risk on. That's rotation into things with a narrative you can still underwrite. Tesla ripping kind of ruins my neat little gravity speech, which is annoying, because I liked that. But it does fit the pattern. Anything with optionality gets bid the second the macro pressure valve hisses open.
Well, it's like the market just collectively exhaled after holding its breath for 3 weeks. But I'm looking at the plumbing, and it's still a bit leaky. I mean, the oil crash is a massive relief for the consumer, but the fact that gold is still rallying, even as the war risk drains out, is the real tell for me. It's shifting from a fear of missiles trade to a fear of the dollar trade, because even with Hormuz reopening, we still have that sticky inflation data looming on Friday. The 10-year sitting at 4.343, barely budged on the ceasefire news. And if yields don't actually move lower on this good news, it means the market is starting to realize that peace doesn't necessarily mean a pivot. And those FOMC minutes this afternoon might just be the cold water that reminds everyone the Fed is still looking at the footnotes, not just the headlines.
The tape is up next. Back in a second. Yesterday, the market basically went nowhere. SPY up 4 basis points, call it flat. But underneath it, there was a real story. Oil-driven inflation fear hit consumers hard. Tech quietly held. Gold bid even as crude faded. Then overnight, the whole picture flipped. Let's work through what drove the session. Consumer names first. XLY down 1.2, XLP down 1.7. Ray, this is your drawer.
See, the thing about those consumer names falling while crude actually cooled off into the bell is that it shows you the market wasn't just reacting to the price of a barrel. It was reacting to the certainty of margin compression. That FT piece on the cruise lines is the perfect microcosm because it really highlights the hedged versus the unhedged reality. If you haven't locked in your fuel costs, a sudden oil spike is an immediate tax on your earnings that you can't just pass to a traveler who's already feeling the pinch. Well, you couple that with the NY Fed data showing that household inflation expectations are creeping back up, and the market starts to realize that even if oil prices dip for an afternoon, the damage to the consumer's psyche and the corporate bottom line is already done. It's basically the market admitting that a soft landing is impossible if the cost of moving people and goods stays this volatile.
And while that was happening, Tom, tech went the other way. XLK up 0.5%. Goolsby late in the session. Slowdown but not recession. Walk us through why that mattered.
Goolsbee basically handed the market a very specific fairy tale. Growth slows just enough to cap rates, but not enough to break earnings. And that's catnip for long-duration tech because their valuations assume the future is both real and discounted gently. So money hid there, not chased, because if you're nervous about margins getting eaten by oil, you go to companies selling compute cycles instead of jet fuel. The thin breadth in Apple/Tesla red tells you it wasn't tech is amazing, it was I need somewhere that doesn't care about diesel prices, which is a different trade entirely. The oil versus AI belief is still intact, just downgraded from religion to a working hypothesis.
Energy and gold both caught a bid, XLE up 0.8, GLD up nearly 1%, but crude actually closed lower. Ray, explain that one.
Oh man, Alex. It's that classic case of the market not believing its own eyes. Well, when you see XLE, the energy stocks, climbing while actual oil in USO is dipping, you're seeing a disconnect between the now and the forever. Traders are selling oil on the ceasefire headline, but big money holds the stocks because they think the peace is just a temporary breather in a structurally broken energy market. It's like everyone's pretending the fire is out while the curtains are still smoldering. And that gold move? If people were truly terrified of a regional war, gold wouldn't be up 1%. It would be through the roof. The fact that it's just drifting tells me this isn't a fear trade at all. It's a liquidity hedge. Investors shuffling cash toward havens because they're worried about inflation fallout from the last month of high oil, not because they think war freezes the world tomorrow. Alex, what's gold at right now? Is that bid actually sticking?
Pre-market, it's at 442, up 2.4% from yesterday's close.
Well, that 2.4% jump is exactly what I was looking for, because it's happening on a relatively quiet morning, which means the war premium is fading and being replaced by a much scarier realization that inflation isn't just sticky, it's structural. When people realize the Fed can't lower rates without lighting a fire under commodity prices, they stop buying bonds and start buying stuff like gold to protect purchasing power from a dollar being diluted by government spending.
Last one for the tape, mixed signals on crypto yesterday. BTC closed the daily candle up 4%, but MSTR was down 3%, and the overnight move gave a chunk of it back. Gold held its bid through all of it. Tom.
Crypto didn't fail as an inflation hedge yesterday. It just revealed it isn't one in practice. It trades like a high beta liquidity asset, so when real rates creep up and risk tightens, it goes down while gold catches the policy mistake bid. Gold's a balance sheet asset for central banks. Crypto's a positioning asset for people with margin. And then today it rips on softer SEC tone, which tells you everything. It's trading on regulatory oxygen and liquidity cycles, not macro fear.
That's the tape. Footnotes up next. A few things that didn't fit in the tape but matter. Ray, you've been watching the FOMC minutes. They drop at 2 today. Set it up.
Yeah, everyone is popping champagne over the ceasefire, but the Fed doesn't trade on breaking news alerts from this morning. These minutes are from the March 18th meeting, and back then, oil was absolutely screaming and everyone was panicking about a 1970s-style energy spiral. If those minutes show the committee was already getting defensive and talking about delaying cuts because of those fuel costs, then this entire morning rally is walking straight into a buzzsaw at 2 p.m. It's a sell-the-rip scenario that nobody is really talking about yet because they're blinded by the crude drop.
10 years at 4.343, up slightly this morning, barely moved on the ceasefire news.
Yeah, bonds just sitting there at 4.34, while equities are doing a small fireworks display. That's not slow, that's, I don't believe you. It's basically saying the ceasefire fixes headlines, not the inflation impulse that was already in the pipe when those minutes were written. So equities are trading the next 2 weeks, bonds are still stuck in March 18th.
Crypto getting a second win this morning, partly on the ceasefire risk on, partly on Bloomberg flagging that SEC enforcement is shifting under Trump. Tom, the SEC angle.
It's not just vibes. A lighter SEC means the difference between we might retroactively decide your product is illegal and here are the rules, go build inside them. which for institutions is basically the difference between zero allocation and a sleeve. The plumbing matters: custody clarity, exchange registration paths, what counts as a security. Once that's defined, pension money can show up without their lawyers having a stroke. Coin and MSTR ripping 5%. That's relief first, reality later. They're pricing the absence of harassment, not the arrival of a fully regulated asset class.
Quick one, 2 global notes. IMF flagged EM vulnerability to flighty hedge fund flows. Same hedge funds have record shorts on European equities. Ray, 30 seconds on why those two connect.
Oh, it's all the same plumbing, Alex. See, if you're a macro fund looking at Europe, you see high energy costs and basically zero growth. So you short those European indices to fund your search for yield in emerging markets. But the IMF is calling them flighty because it's the exact same pool of hot money. And if this ceasefire actually sticks and energy costs drop, those record shorts in Europe are going to get squeezed so fast it'll make your head spin.
The squeeze is real if energy holds lower. Last one. FTSE confirmed Vietnam joins the Emerging Markets Index in September. Tom, one line.
Index trackers don't have opinions. They just wake up one day and start buying Vietnam because the spreadsheet told them to.
Nerd Corner is up next. Was that bagpipes again? Where are they coming from?
Every single week.
Anyway, Nerd Corner.
Tom's Corner. The thing I want to understand. Oil is down 11% this morning. AI names are up 3 to 4. That correlation has been broken for a while. Is it structural or just a coincidence?
It's mostly structural. The hyperscalers don't buy energy the way the rest of the economy does. They sign these long-term power purchase agreements, PPAs. So the price of electricity for a data center in Ohio is basically pre-negotiated years out. Oil can spike 10% in a day and it's irrelevant, because their marginal cost of compute is already locked, whereas an airline or a cruise line is effectively swiping a credit card at the pump every morning. So the market looks at NVDA and goes, your input costs are stable, your demand is exploding, and it just stops caring about oil. Where it leaks back in is second order. Diesel for backup generators, steel and cooling systems tied to energy-intensive supply chains, construction costs for new data centers. So if oil stays high long enough, CapEx creeps up and timelines slip. But day-to-day, oil is a headline, AI is a contract.
Tom, that is such a clean way to put it. But that's exactly what keeps the guys at the Eccles building up at night. If you've got this massive high-growth engine immune to the energy tax because of those long-term contracts, then the Fed's traditional tools start looking like a sledgehammer trying to fix a Swiss watch. They're hiking rates to cool demand. But if the AI sector is just humming along on its own private power grid, the only way to bring down aggregate inflation is to absolutely wreck the people who do swipe their cards at the pump, like those cruise lines getting hammered yesterday. It's a weird bifurcation where macro policy becomes a game of collateral damage, and the 10-year sitting at 4.343 while equities rip tells you the bond market already suspects the Fed's math doesn't add up.
But Tom, those PPAs expire eventually. What happens at renewal if energy costs have been structurally higher for 3 years?
Yeah, renewal risk is the whole game, but they're not sleepwalking into that cliff. Microsoft, Google, Amazon, they've spent the last year panic buying time. Nuclear PPAs, SMRs, even restarting old plants like 3 Mile Island, which is a sentence I didn't expect to say in 2026. The hedge isn't financial, it's physical. Lock in baseload power for 10 to 20 years so when contracts roll, you're not negotiating with a gas spike. If they get that right, renewal becomes an accounting event. If they don't, it becomes everyone suddenly remembering what margins used to look like.
Tom, that's the pivot. It's like these guys are building their own private macro economy. Because nuclear is basically the ultimate inflation hedge. If you lock in 40 years of fixed cost baseload, you're essentially opting out of the energy cycle entirely. Which means the Fed can hike until the 10-year screams, but it won't touch the operating costs of a hyperscale data center. They're insulating themselves from the very tools the central bank uses to control the rest of us. And the bond market is sitting at 434, barely moving this morning. Maybe it already knows.
Oil is a headline, AI is a contract, and apparently nuclear is the escape hatch. Calls are up next. Prediction time. Before we make new ones, Tom, your Tesla call from episode 1 is due today. You called it, tags $350, breaks through with conviction, people quietly giving up on the quarter. It's at 363 pre-market, up 5% on the ceasefire. What do we do with that?
Yeah, I'm wrong on the timing. The ceasefire just jammed a crowbar under the whole tape, and Tesla got dragged with it. That's not conviction, that's correlation. The actual problem didn't go anywhere. It just got rescheduled.
Rescheduled. New call, Tom.
Apple's down 2% in a tape that's up 3%. That's not a glitch. That's funding. I think AAPL finishes red today, even if QQQ holds above plus 2%, because this is money rotating into higher beta AI names on the ceasefire and rates relief combo. And Apple's just there. If it's still negative by noon, it stays offered into the close, while everything else pretends it discovered growth again.
Ray.
The positioning was so lopsided against Europe, and they're the biggest beneficiaries of this de-escalation. Energy costs just got a 2-week holiday. Those record shorts are waking up to a disaster. My call. European equities outperformed the S&P by at least 1 full percentage point by Friday's close. The ceasefire fixes the continent more than it fixes us, and those hedge fund shorts have to cover. The squeeze is already starting.
Mine. Gold holds above 440 through Friday's CPI print. The war premium is gone, but Ray's right that this is an inflation hedge now, not a fear trade. If CPI comes in hot and gold doesn't sell off, that's the confirmation that something structural shifted. I'll take that trade. That's episode 3, Wednesday, April 8th. 3 clowns. Find us on Spotify, Apple Podcasts, wherever you listen. FOMC minutes at 2, CPI Friday. We'll be back tomorrow. Tom will have had more coffee.
Probably.
See you tomorrow.